August 2025, Jackson Hole, Wyoming. Every year, central bankers from across the globe gather right here to chart the course for global monetary policy. A few meters from the official venue, the Wyoming Blockchain Symposium is holding its own sessions, headlined by the president's son, Eric Trump. Traditional monetary figures are also in the room. You have Federal Reserve governors like Christopher Waller sitting shoulder to shoulder with crypto evangelists, competing for attention with the world's most influential bankers. The Trump administration staged this parallel meeting as a calculated cosmetic concession to the crypto industry. This alliance marks a strategic pivot that ties the future of stablecoins to the US Treasury and the continued dominance of the dollar. To understand why the administration is courting the crypto world, we have to look at the math. The United States is managing a $1.8 trillion deficit in 2025, with a total public debt exceeding 100% of the national GDP. Here is the paradox. The Federal Reserve slashed benchmark rates, yet long-term interest rates kept climbing. This disconnect forces the government to issue new, expensive treasury bonds just to pay off old debt. It's an accelerating cycle feeding right back into the deficit. Escaping this spiral leaves lawmakers with limited options. Cutting public spending on the scale required is politically unviable. The only remaining survival path is to generate massive global demand for US Treasury bonds. The government requires a system that recruits buyers automatically, a mechanism that ensures constant demand for US debt without having to persuade individual investors. That mechanism relies on stablecoins. Think of them like casino chips. Inside a casino, you exchange your cash for chips that hold a strict one-to-one value with the dollar, but they only function within that specific environment. In the digital world, this market is worth over $300 billion. It is dominated by a few major players, primarily Tether and Circle, which markets its tokens as fully backed digital dollars used for instant international transactions. The companies issuing these tokens don't keep your physical cash idle. They take those billions of dollars and invest them into highly liquid, low-risk assets. This generates massive yields for the issuing companies, while the person holding the digital token receives no interest at all. The Genius Act, signed in June 2025, integrated this private stablecoin market into the federal government's financial architecture. The law mandates every stablecoin be backed one-to-one by reserve assets, restricted almost exclusively to US government liabilities, like treasury bills. It also prohibits using these reserves for other purposes and legally bars paying interest to token holders. This turns the stablecoin ecosystem into a captive buyer for US public debt. Every new token minted automatically equals new debt purchased. Normally, buying a treasury bill locks your money away as savings. You have a bond, but no cash to spend. Under the Genius Act, when a stablecoin issuer buys that debt, the user receives a digital token that functions like money. The consumer retains their original purchasing power for goods and services, while the government simultaneously receives the cash to fund the deficit. This system is scaling rapidly. The stablecoin market is expected to reach $3 trillion in the coming years. This creates hundreds of billions in new demand for US debt, lowering borrowing costs without draining liquidity from the economy. This architecture provides the White House with a mechanism to fund spending without immediate pushback from the market. If the government uses this captive demand to spend recklessly, the result will be a return of runaway inflation. The machine is built. The only question is whether we trust the engineers who control it.
Look at the soaring prices of gold and silver lately. These are the visible symptoms of a massive, quiet financial war currently raging right beneath the surface of the entire global economy. To understand what's happening, you have to look at the traditional setup. For decades, banks operated with a simple advantage. You deposited your money, they paid you a tiny fraction of interest, and they didn't have to worry about the crypto sector competing for your basic checking and savings accounts. Then came the new regulatory framework known as the Genius Act. On paper, it gave traditional banks a major concession. The law explicitly prohibited the actual issuers of stablecoins from paying any interest to the people holding them. This diagram illustrates exactly how the loophole functions. While issuers couldn't pay you, cryptocurrency exchanges were perfectly free to offer rewards. Suddenly, platforms like Coinbase and Kraken started paying customers yields that can top 4% a year just for holding stablecoins. This loophole has turned cryptocurrency exchanges into high-traffic financial hubs. By offering returns that traditional banks simply aren't allowed to match, these digital platforms are now massively drawing in the exact same deposits that used to sit quietly in your standard savings accounts. This scale visualizes a staggering estimate from an April 2025 Treasury Department report. Over $6 trillion in traditional bank deposits could migrate directly into stablecoins. If even a fraction of that capital leaves the traditional banking system, banks lose their base lending capacity. They would be forced to drastically hike the interest rates they offer to keep your money, which immediately skyrockets the cost of private sector loans for things like homes and businesses. The legacy banks see the math. Institutions like Citi and JP Morgan aren't standing idly by. They are frantically developing their own digital tokens and deposit systems to stop the bleeding. The government knows exactly how much damage this capital drain inflicts on the traditional banking sector. Which brings up the obvious question: why is Washington actively encouraging a game this dangerous? To understand why the government is allowing this shift, we have to look at the Treasury Department's own balance sheet. There is a specific strategic motive behind why stablecoin growth is being encouraged. This flowchart tracks retail money entering the ecosystem. The Genius Act mandates stablecoin reserves be backed by dollar-denominated assets. Buying a stablecoin triggers an automated, legally mandated purchase of US public debt to back that token. Add in the political reality. The administration's election campaign was heavily financed by the crypto industry, quickly appointing a pro-crypto head of the SEC. The Trump family even launched their own stablecoin, the Trump World Token, operating directly in the very market they are regulating. Washington is accepting the risk of instability in traditional banks because it provides them with a massive automated financial engine to continually buy US debt and reduce the public deficit. But the architects of this system are looking far past domestic borders. The ultimate objective here is to lock in the international dominance of the US dollar for the digital age. They achieve this through extraterritorial regulation. Under the new law, any foreign stablecoin issuer that wants to operate within the lucrative US market must prove their home country's regulatory regime matches American standards. The decision to grant that market access is left entirely to the discretion of the US Treasury Secretary. It is revocable at any time, subject to ongoing review, and acting as a unilateral veto over how any other nation regulates its digital money. This creates massive pressure abroad. Rapidly expanding crypto hubs in sub-Saharan Africa, Latin America, and even the European Union are now being forced into a corner, abandon their local, sovereign financial regulations, or get locked out of the US ecosystem. The strategy is clear. The United States is aggressively weaponizing its market access, forcing the global digital economy to default to the American dollar and US oversight, establishing an inescapable layer of geopolitical leverage. In 1944, world leaders met openly at Bretton Woods to design the global financial order. Today, a similar shift is occurring, but it is driven by stablecoin transaction volumes that now exceed $1 trillion a month. But we have a disturbing historical precedent for this exact type of financial structure. In 2007 and 2008, prime money market funds promised investors stable value backed by perfectly safe assets. When the subprime crisis hit, those assets suddenly weren't safe anymore. Stablecoins could easily trigger a similar dynamic today. If a sudden crisis of confidence leads millions of users to massively redeem their tokens all at once, it could crash this entire parallel system, potentially requiring multi-billion-dollar government bailouts to stop a total collapse. This side-by-side comparison shows the severe volatility hidden within those reserves. Circle holds virtually the stablecoin market, holds roughly 20% of its assets in highly volatile, non-cash equivalents like Bitcoin and corporate bonds. The US government has leveraged the digital economy to maintain its financial supremacy, but in doing so, it has constructed a parallel banking system that delivers immediate help for the public deficit while introducing deep systemic risks for the global financial system.